Have you ever gotten that feeling like there's a different set of financial rules for some people? Well, you're right, there is. And today, we're going to deconstruct that exact blueprint. Now, this isn't about finding shady loopholes. It's about understanding a system of incentives that's actually designed to reward specific actions. So let's reverse engineer the whole strategy piece by piece.
Okay, so here's our roadmap. We're going to start with the most important part, the core mindset shift. Then we'll talk about building your financial fortress. From there, we'll fire up the engine of wealth growth, acquiring and leveraging assets. We'll dive deep into the art of the deduction, look at the multi-decade long game, and finally, we're going to tackle a really critical question for today. In the age of AI, who should you actually trust to guide you through all of this? All right, first things first. Before we even talk about a single tactic or a single tool, we have to address the fundamental shift in mindset. This one philosophical difference is the entire foundation for building wealth strategically, and honestly, it's where most people get it wrong right from the start. Now look at this, because this slide right here reveals the critical difference. It's all about the order of operations. See, an employee, a reactive earner, earns income, immediately pays taxes, and then gets to spend whatever is left over. But a strategic planner, like a business owner, flips the script. They earn income, then they spend on deductible business expenses, and only then do they pay taxes on what's left. That simple change in the sequence, that is the key that unlocks this entire system. And this is the core idea you have to grasp. The tax code isn't just a penalty box. It's more like an incentive map. It's literally designed to encourage certain behaviors. Things like creating jobs, providing housing, or funding new businesses. Once you learn how to read this map, you can align your entire financial strategy to move with the current, not fight against it. Okay, so you've got the mindset. How do you actually put that philosophy into practice? Well, you start by building a fortress. Before you even think about growth strategies, you absolutely have to have the right protective structures in place. So let's look at the essential legal tools you need. The first layer of your defense is usually the limited liability company, or LLC. Its main job is to build a legal wall, a firewall, between your business assets and your personal assets. So if, God forbid, the business gets sued, your house and your personal savings are shielded. It also forces you to have clean record keeping, which is great, and it can even provide a nice layer of privacy. Now, the next layer of this fortress deals with your legacy, the trust. A revocable living trust is just a super powerful tool that lets your assets pass directly to your heirs, which means they get to bypass that lengthy, very public, and often expensive court process known as probate. It's all about ensuring a smooth, private transfer of wealth to the next generation. All right, with the fortress built, it's time to fill it with treasure, right? This is the active part of the strategy. This is the engine that actually drives wealth growth. And it's really a two-part process. First, acquiring assets that grow in value, and then using those assets to create even more opportunities. So the fuel for this engine comes from assets that appreciate over time. We're talking about things like cash-flowing real estate, broad market index funds like the S&P 500, shares in those big dominant companies, and of course, your own business. You can also have strategic hedges like precious metals or even some digital assets to protect against volatility. This all leads us to a really powerful, famous strategy known as buy, borrow, die. I know, it sounds super dramatic, but it's brilliant. Here's how it works. Step 1, you buy, appreciating assets. Simple enough. As long as you just hold them, you don't pay any capital gains tax. Step 2, you borrow against their increased value. And since a loan isn't considered income, this gives you tax-free cash to go reinvest or even live on. The final step, die? Well, that's where the real magic happens for your heirs. And we're gonna uncover that trick a little later on. Okay, so to make this whole system work as efficiently as possible, you have to minimize that tax drag along the way. And that's where we get into the nitty-gritty, the specific mechanics of deductions. These are the tools that let you legally reduce your taxable income. Depreciation is seriously one of the most powerful tools in the entire playbook. Just think of it as a paper loss. The tax code basically lets you deduct an asset's cost over time because of wear and tear. But here's the incredible part. You get to take this deduction even while the asset itself, like a rental property, is actually going up in market value. It's amazing.
And believe it or not, it gets even better. With tools like 100% bonus depreciation, you can potentially deduct the entire cost of a qualifying asset all in the first year. The classic example you'll always hear about is a business vehicle over 6,000 pounds. So instead of taking small deductions over 5 years, you get one massive paper loss right up front to offset your other income. And beyond depreciation, remember that any expense that's considered ordinary and necessary for your business is also deductible. And this is so important. This includes the fees for your professional team, your attorneys, and your accountants. The system literally incentivizes you to hire experts to help you navigate it correctly. So now let's zoom out from the year-to-year stuff and look at the real long game. Because the goal here isn't just to reduce your taxes this year, it's to manage, to defer, and ultimately to eliminate capital gains taxes over an entire lifetime. A classic example of this is the swap till you drop strategy in real estate. So instead of selling a property that's gone up in value and paying a huge capital gains tax bill, you use a special provision called a 1031 exchange to just swap it for a bigger, better one, and you roll that tax bill forward. You can keep doing this over and over, swapping up indefinitely and just deferring those taxes for decades. And this is the final, most powerful piece of the whole puzzle. Remember buy, borrow, die? This is the payoff. At the end of that swap till you're dropped journey, or really whatever you pass on any appreciated asset, your heirs receive it with something called a step-up in basis. What that means is the asset's cost basis gets reset to whatever its market value is on the date of death. And poof, all those decades of deferred capital gains are completely wiped away, gone, tax-free. Okay, so it's pretty clear this entire blueprint is complex, right? It's got a ton of moving parts, and the laws are constantly changing. Which brings us to a really critical final point. What's the role of expertise in a world that's becoming more and more automated? I mean, it's the obvious question. With these powerful AI tools that can analyze the entire tax code in, seconds? Do you even need a human advisor anymore? Can an algorithm just execute this entire complex blueprint for you? Well, for now, the answer is a hard no. And here's why. A licensed professional is legally accountable for their advice. An AI is not. A human expert understands your unique personal context, your family, your goals, your risk tolerance. An AI only knows the prompt you gave it. And maybe most critically, a professional is liable for their mistakes. With an AI, all that liability is on you. My chatbot told me to do it is not a defense the IRS is going to accept. But here's the real danger with AI, and it's subtle. It's not that it'll be completely wrong. It's that it will be 90% right. It can give you a really plausible sounding answer that just subtly misinterprets one little rule or even makes up an IRS code section. These AI hallucinations are so risky because they build this false confidence that can lead you into making some really costly mistakes. So the key is to use AI as a powerful assistant, not as your advisor. Use it to learn the basics, to generate checklists, to formulate smarter questions that you can bring to your human expert. It can make you a much more educated client. But you must always verify its output with a licensed professional before you make any real financial decision. So that's the blueprint. It's a completely different way of thinking that focuses on structure, on leverage, and on long-term strategy, all guided by that incentive system built right into the tax code. It proves it's not just about what you earn, it's about how you structure what you earn. And the only question left is, which set of rules are you playing by?